Now, just investing in the S&P 500 is a great investment and on average produces a return of over 10% per year. But my new 3-fund portfolio has been blowing that out of the water for the past 10 years and does so while producing a higher cash flow and a higher ceiling to be able to reach even further gains, especially if AI and technology keep producing at the levels they've been going. To simplify for an example for this video, I set this portfolio to be even amounts of VOO for the S&P 500, SCHD for dividend/value, and then SCHG for growth. Compared to the S&P 500 alone over the past 10 years, it's winning by a landslide. The S&P 500's up 194.34%, but my new 3-fund portfolio is up a whopping 267.74%. Like I said before, the S&P 500 brings a great average annualized return, and over the past 10 years, it's averaged a return of 11.49% per year. My new 3-fund portfolio has had an average yearly return of about 14%. If one starts with $50,000 and puts $500 per month into a portfolio that returns 14% per year on average, in 20 years, they would have $1,233,324, all from just $500 per month invested. This year alone, I've seen an increase of about 25% on some of my investments. So let me share with you how I did it and then how you can do so in the future. My name is Nolan Govea, my students call me Professor G, and I made this channel to make investing simplified. So obviously this year's been crazy in the stock market with Trump tariffs and Fed rate talks and geopolitical issues. We saw a huge market decline in April, and during that time, so many people either exited their US-based funds or just stayed out of the market altogether. Many people saw the S&P 500 and other US indexes down 10 to 15% and decided to cut their losses and throw it into something that maybe was a bit more attractive because it was at least stable. At the time, bonds was one of the only things that was actually positive within the US, and it was something that at least could provide some stability because people didn't like seeing their portfolio drop so much day after day. During that big dip in April, I explained that I would be continuing to buy and actually buy more heavy and double down into the 3-fund portfolio rather than head for the bonds. Those that did that same thing saw some monster returns. I'm going to go over the year-to-date returns for a bunch of different assets, but even more so after this one, I'm going to show you how much you would have made if you just would have bought the dip at the time that I said that I was buying the dip. So overall, here's the year-to-date returns as of right now in the middle of July in 2025. The S&P 500 is about 7% year-to-date. The NASDAQ Composite's up about 6.6%, Dow Jones Industrials up about 4.3%, and the US aggregate bonds is up about 3.2%. So bonds have stayed at about 3% all year. So when the S&P 500 was falling like crazy and it's down like negative 10-15%, and you see something like bonds that's up 3%, psychologically it seems like the move to be in something that's up rather than down, right? Well, the problem is that just a couple months later, now we're seeing, even including that huge dip that we saw in April, the S&P 500 for the year to date is up 7% when bonds is still just at 3% or so. At the very least, the better move would have just been to stay in that asset, stay in the S&P 500 rather than jump ship. But even bigger than that was to do what I did, which was to buy the dip, especially at that time. Here are the numbers had you bought during that dip in April. For QQQM, the price bounce was 20 to 25% depending on when you bought. For VOO or the S&P 500, that's up 20 to 24% since that April time. And then even SCHD is up 7 to 8% from that initial drop. Understanding market cycles and understanding that people just make emotional decisions and they usually panic during those situations is so important if you're going to be a long-term investor and you're trying to build long-term wealth. I knew that the market was overreacting to the tariffs or the announced tariffs and to the whole situation at hand. Even more important though was that I did deep research on those 3 funds and understood deeply what the heck they actually were And so when I saw such a big price drop in all of those, I knew that it was a steal to be getting in at that point. I'm perfectly happy buying in right now at the levels they are today. So when I saw something that was 10, 15 or more % down, I just knew for a fact I needed to get in on that and double down. Now I'm sure that you know and I'm sure that you understand, but it's not just time to buy just because things drop in price. Like, it's not necessarily going to be your best move if you see some individual stock down 25%. That just doesn't mean, okay, 100% buy right now. That could very much mean this stock is bad and that it's going to head for some bankruptcy or something. But when we're talking about ETFs, especially tried and true ETFs that are broad, that are solid, that have been solid, and have a 20 or more year track record, when they drop by that percentage, I'm all in. And yes, the elephant in the room, SCHD has lagged the other two in the 3-fund portfolio. It's pretty much lagged most of the ETFs that people are interested in. Many people are hating on value style and specifically SCHD right now, and if I'm just gonna be real, it's because they don't understand long-term investing, or they're just not a very mature investor as it is. If your goal is long-term sustainability and long-term growth for this portfolio, and to actually build real wealth, you need to mitigate risk. Do you really think that technology and AI is going to boom as hard as it has literally forever? If you think that, look back to the dot-com bubble. At that point, people were putting crazy high valuations on the hot thing at that point, which was www or the internet. Literally any stock that had the words .com in it was blowing up by crazy multitudes. And nobody thought that any of that was ever gonna stop until it did, and that bubble popped hard. Now, I'm not saying that AI right now or even technology is in a bubble, but it is overvalued, and at some point it just has to at least stall out, possibly drop. And when that happens, value's gonna have its day. Just like it has multiple times if you look back in the history of the stock market. SCHD does not have much technology within the fund, and obviously right now, AI and tech are the hot ticket. Everything moves in cycles, and right now AI is the hot hand, which is great because 2/3 of this portfolio has a very heavy amount of AI technology and those growth style companies within it. But even in my underperformer of SCHD, I've made about 8% on my investments, especially buying in at the dip time. Since mid-April lows, SCHD climbed to about 27.33 by July 12th, marking a 7.5% price recovery. On a total return basis, SCHD's returned about 2% year to date as of July 11th, highlighting a slower, more income-oriented rebound. SCHD is a stability-first profile. As a dividend/value ETF, SCHD prioritizes stability and income over fast recovery. So what does this all mean, and why is SCHD still a very core piece of this 3-fund portfolio? If you're income focused, this downturn presented a chance to buy at a discount while collecting dividends. And looking ahead, SCHD's performance may stabilize, but unless large cap value rebounds materially, it may continue to trail momentum-driven indices. Also remember that you do get an income cushion. There's quarterly payouts which provide some return support during the dip. You also have to very much keep in mind this higher rate environment that we're in. Everybody's talking about and everybody's watching the news for this Fed rate drop, right? This Fed rate cut that's supposed to happen either in the next month. I think it's going to be more so in September, and then again by the end of the year, and then a bunch of times in 2026. But when that rate gets cut, that means things like your high yield savings account and certain bonds and other types of accounts like money market accounts are going to start lessening as well. If you're getting 4% right now in your money market account, soon it's going to be something like 2%. At that point, wealthy investors will find the next least risky assets, and those will be value funds like SCHD and VYM that are gaining about that 4% dividend in a safer, sustainable way. The time to get into something like SCHD and VYM is not then when everything has come down and when now it's attractive to get into the fund. It's right now when everybody is kind of overlooking it and just seeing the the hot hand at this point. Because later on, when SCHD is way more attractive, it's not going to only be at about $27 a share, it's going to be something like $30 or $35 a share, and so then you're going to have to buy in at much more expensive. This is the genius of the 3-fund portfolio though. When growth and momentum are taking off, you'll benefit from the growth section and some of the S&P 500 foundational section. When growth stalls out a bit and value takes over for a couple years, you'll benefit from the SCHD portion and some of the value section of the S&P 500 foundational section. To be the best investor possible, you need to not only have just a very good 2 or 3 years, you need to have a consistent solid return no matter what part of the cycle that we're in. Since we have no crystal ball as to when this AI and technology part of it is going to slow down, you need to keep yourself covered by having some value there and ready so that there is no lapse there. The issue that I'm seeing a lot of with this 3-fund portfolio and the pushback that I'm getting is people are asking, why not just invest fully in growth right now? Put 100% in that because that is the hot hand. And then when growth drops, then you're gonna buy into like an SCHD when that goes up. Well, if you really think about what's gonna happen there, if you're doing that 100% growth, it goes up a certain amount, the only way you're gonna know that it's time to switch is when growth starts dropping. So that means inevitably your 100% of your portfolio will drop 5%, 10%, 15% possibly. Not only that, on the other end, SCHD will be going up at that point. So this is getting more expensive. So now you're gonna sell at a loss, buy into something that's more expensive at that time, and you will have lost out on something like 15 to 30% because of what you're doing there. So in theory, it only works out if it's absolutely perfect. Once that growth hits the absolute top, you need to have sold it to then buy at the bottom of SCHD possibly, and then ride that up. And that is almost impossible. I've been preaching the new 3-fund portfolio ever since I developed it after doing a whole bunch of studies for my master's and in my PhD program. I started investing primarily in that format for years before I even started this YouTube channel, and then I just started telling people about what I'm doing. Now many of my richest clients invest in that exact same way and have for quite some time, and so I have data to prove that this is a very solid and sustainable way to invest. It's also incredibly simple, and it helps you be able to sleep at night while not having to look at your portfolio each and every day. To learn more about the exact percentage based off of your age, watch this video here because it does change based off of your age or life stage. Or watch this video to keep you going strong in investing, and remember to keep investing simplified.